on the Money Council. It's a new YouTube channel I've started, just sort of exploring financial markets, and I'm being able to disseminate a lot of the sort of bugs and challenges that many of us face as ordinary people in managing our finances, and whether it's investments or any other aspect thereof. And obviously with you on the show, it brings back a lot of memories.
Yes.
You shared with me where we did 100 episodes on investment matters. I mean, that's
right.
Amazing experience. And I think I'm still sort of following that course of route in terms of presenting and sort of educating the public and sharing, some of the ideas and things that I've learned, and also connecting with some of the investment professionals like yourself that I've built relationships with, and bringing that to the public. So Abdul, the theme is obviously around being beaten by investment markets. And the question is obviously, or are we beating ourselves at investing through investor behavior? And we're going through unprecedented times. We find ourselves going through this Covid-19 pandemic, which has affected the humanity globally, on a social level, on an economic level. And in our space, where we're obviously looking at the investment markets, it has affected, most major indices and markets. Particularly in South Africa, we've seen the JSE sort of hitting bottoms or close to 30% during, Jan to April 2020. And we're obviously seeing the market slowly recovering now. And the government obviously tried to tactically phase sort of level of restrictions so that they can flatten the curve. We saw the Reserve Bank reducing the repo rate by 200 basis points. We're at just under 4% at the moment in terms of repo rate. And it's probably at all-time lows. We've now moved out of level 4 into level 3 in terms of the restrictions in South Africa to somewhat open up the economy, because it is much needed. We do understand also that this puts massive pressure on the government in terms of debt levels. Their tax receipts are falling, and there's so many other things we can touch on. And that's why I wanted to have you on the episode to sort of just briefly unpack some of these aspects that have affected the market, that has affected local markets, etc. So over to you.
Okay, so there's a lot of things to discuss. I think let's start with the first principles. And your viewers are typically people, the man in the street, the layperson. And some of these topics are probably too in-depth to cover in the space of 20 minutes.
Yes.
But also, how does it affect them? And I always try to bring it back. How does it affect the man in the street? How does it affect the ordinary person?
Yes.
And, the one thing that we do know is that, as you rightly said at the beginning, everybody has been affected by this pandemic. Be it, people that have been furloughed or let go in terms of employment, or just people that are working from home or, sitting at home, not receiving any income, to those essential workers that are continuing to work, but are facing, unprecedented sort of challenges in terms of exposure to the virus, etc. as well. So I think, bringing all of that back and just keeping it simple in terms of saying, for many people, as you rightly said, it's a pandemic, it's unprecedented. But I think the silver lining here is that, this will pass. There will be light at the end of the tunnel. Be it a year, be it even 18 months. I think the one thing that we have seen globally is our human resilience and our ability to work together as a humanity. It's also unprecedented in terms of the scale and the global concerted effort to find a vaccine, for example.
Yes.
So I think, and also, we've evolved over the last 100 years, in particular, in terms of technology, in terms of research and development. And all of that means that, what would normally have taken us 5 years or 10 years to accomplish now can be achieved in 3 to 5 months. So that means that I think we're in an environment where, there's a lot of resources being pulled together and being applied to find a solution, to find a vaccine for this. And once we have that, I think not only will we be able to, recover from this pandemic, but we'll also be able to withstand future pandemics as well. And I think that's quite an important, point to make. So having said all of that, I think what is critical for everybody is if we can survive and come through this pandemic, maybe a little bit poorer, but with our health intact and with, largely our, wealth that we've built up over many years to a large degree intact, I think we will be okay.
Sure.
Now, what does that mean? What does that mean actually for the person in the street? As you rightly said, I mean, we're trying to make sense of the markets and trying to see whether the market has beaten us or we being beaten by the market, as you said. And I think let's start there. I think what is important is that this is a 1 in a 100-year event. We haven't seen the scale and the nature of this before. But likewise, investing is a long-term process. It's a long-term journey as well. So the critical thing is not to panic and not to run for the hills and not to sell everything. Especially in March. I mean, as you rightly said, the market was down about 33%, from February to the bottom of March. But since then, the market has rallied 44%, from that March low to as recently as last week. We have seen more volatility over the last week as well, where the markets have retraced about 5%. But anybody that would have sold their investments at the bottom in March would have missed out on a 44% rally.
Yes.
And you would have lost out on recovering more than 50% of what you've lost previously. And I think that's a critical point as well. Likewise, for any person that is maybe not close to retirement, that can invest for the next 5 to 10 years, and that can actually stay invested. I mean, clearly, if you have needs in terms of having to live, having to feed your families, etc., that's a different story. And then you need to access your savings and try and avoid debt in particular. But for those people that can actually afford to stay invested, clearly the biggest thing that they can do now is not panic and just keep your money invested as well. What will happen in the next couple of months? We think that markets will remain volatile. Clearly, there's been news flow around potential second waves of the virus coming back, etc. I think the one thing we do know is that there has been significant stimulus that have been applied to global markets. Yes. And whilst we South Africa, and you've mentioned that we've got already a constrained balance sheet as a country. I mean, we're sitting with a debt to GDP ratio in excess of 60% already. And with the 500 billion of stimulus and with the loss of tax revenues, as you've mentioned, we are likely to see a more sort of pronounced increase in their debt burden as well. I mean, on our numbers, we're looking at just over 80% debt to GDP ratios in a year's time. Having said that, though, I think, we are in a similar boat to many other countries and many other emerging markets as well. So it's not that we're in isolation here. And so I think that's a positive as well. So I think overall, just to summarize the impact from markets before we talk about investor behavior, is that I think that markets will remain volatile probably towards the end of the year. But once I think we're very close to a vaccine, I think by the end of this year or early next year, a credible vaccine should be available on a mass scale. And then we should be through the worst in terms of the pandemic physical impact. The emotional scars and the financial scars will probably linger for a while longer. But that's why we need to recover. There's a rebuilding phase that we'll need to go through. And that will probably take 2 years to 3 years to do that. But likewise, as I said, if we can get through this largely with our wealth and with our health intact, we will be okay for the next 3 to 5 years as well.
So, I mean, on that note, and before we kind of move into the investor behavior discussions and some of the investments insights, I just also wanted to just look at some of the investment sort of positions that you guys have at Kagiso and the investment team, and with a particular attention to the Islamic funds that you have, which is the equity fund, the balance fund, and the high yield fund. Sort of speaking to a conservative, moderate, and aggressive type of investment approach. And maybe just looking at some of the highlights that you're looking at and some of the opportunities that you've looked at during these times, but also looking forward into the future.
Yeah. Okay, so I mean, so we spoke about the market, we spoke about sort of the global impact and how that, you know, from governments, from vaccines, all of that. Let's narrow it down to what is important for our viewers and for people that are looking and listening to this show and broadcast, and in particular people that maybe have unit trust investments, people that are exposed to the South African market. So as you rightly said, I mean, we obviously have our Islamic equity, Islamic balance in our Islamic high yield funds. And they are clearly in the various risk buckets in terms of, you know, risk spectrum and profile of investors. And if one looks at the equity fund in particular, what we've done there, and I think that the great thing about Sharia investing is that, you know, one of the fundamental principles of Sharia is the avoidance and, you know, abhorrence towards debt and highly indebted companies in particular. And I think the one thing that we've learned, you know, if you look at the February to March period, companies with high debt levels were excessively punished in terms of weaker share prices during that period. Admittedly, they recovered quite a lot in terms of the recovery period from March to April. But likewise, now in the second wave of declines, we're again seeing those companies coming under pressure. And, you know, many of your viewers will probably resonate strongly with a company like SASOL, because over the last 3 months, I've had probably 100 different calls and questions around SASOL in particular. And I want to use SASOL as an example. So we had a SASOL position. When they reported their results in March, clearly the debt levels were significantly higher. We sold out of SASOL completely because from a Sharia point of view, it was no longer compliant. Having said that, if you look at the SASOL business, clearly it's exposed to the oil price, it's exposed to chemical prices in particular. But unfortunately, SASOL is caught effectively, as I always say, caught at the wrong place in the wrong time. They're caught in the wrong place because they've got this US operation, and they're caught at the wrong time because at a time of extreme volatility in oil prices, SASOL has probably the most extreme balance sheet position that they've ever had in terms of the amount of debt that they've got. So the problem with SASOL was always that they spent about $11 billion on this plant in the US, and the hope and the idea was to recover that investment over the next 3 to 5 years through significant global growth and the demand for plastics in particular. Clearly, a lot of those assumptions will no longer be relevant. We're probably in the worst sort of economic contraction that we've seen since the global financial crisis in 2009. So we're unlikely to recover a lot of that investment that SASOL has made. And then secondly, we've seen a significant blowout in terms of the Rand-dollar exchange rate. So SASOL made their investment decision when the Rand was about 12 Rand to the dollar. I mean, the Rand touched 19 Rand to the dollar as well. And still hovering about the 17 Rand to the dollar level. So if you take $11 billion multiplied by 17, that's almost 200 billion Rand of debt that you've got. And SASOL's market cap is around 40 billion. So clearly they've got way too much debt and are likely to recover all of that debt through significant growth in terms of their revenues. So the business model we think is stretched, and the company itself has admitted that they need to realize investments, sell assets, etc. as well. So the investment case has been constrained. So if you look at the impact of that on the SASOL share price, so SASOL started the year at around 300 Rand a share. It went down to as low as below 30 Rand a share during the crisis. But then it jumped up again. It went over 150 Rand a share again. And likewise, it's now back to around the 100 Rand level again. So clearly it's a very volatile share. It's a stock that, you know, we know very well, but we know that management and the company has very little control over the two key variables, being the Rand-dollar exchange rate and the oil price. So again, it's not for the faint-hearted. It's not a Sharia compliant stock anymore, and it's probably a stock that many people, you know, it's a feast or famine stock. If you invested at 20 Rand and you rode it to 150 Rand, well and good on you, and obviously you would have made money. But likewise, you would probably need to sell it at 150 Rand because clearly you would have lost about 30% already since those sort of levels as well. And SASOL is a good example of what we see in the market as well, that excessive volatility where companies with high debt levels, with high sort of macro variables are more exposed than more sort of defensive companies as well. I just wanted to talk. So just to unpack what we've done in terms of our portfolios. So if you look at our portfolios, we've got companies that are global companies in nature, but are domiciled in South Africa. So in particular, the PGM miners, if you take a company like Anglo Platinum and Northern, for example, where the rand dollar is today, they're making significant money from the revenue basket that they generate.
Yes.
So because it's platinum, it's palladium, it's rhodium, the platinum price hasn't done as well, but the palladium price and the rhodium price has actually done exceptionally well. Now you overlay that with a very weak rand dollar exchange rate, their basket prices are up about 30% in the first 5 months of this year.
Yes.
So the platinum companies or the PGM companies, you know, has been a standout in this market. Clearly, they went down significantly in March, but they've also recovered quite significantly as well. So we think that that is still a market where, you know, if you look at the end markets, it goes into the automotive sector in terms of car manufacturers. It goes into the jewelry market. It goes into investment demand. So it's a fairly well-diversified sort of mix. And sure, you know, auto manufacturers will probably come under pressure in terms of their short-term demand. But already we're seeing significant stimulus and talks of stimulus in Europe, in the US, etc. as well. So we think that that market will probably be more protected and better off compared to other consumer-facing markets. I think thinking of tourism and leisure, the hotel industry, those markets will be under significantly more pressure than the automotive sector, for example. So that's an area where we've, you know, find comfort in the market and where we've got exposure in. And then generally we favor companies that what we call global companies that are domiciled in South Africa. If you look at a company like MedAir, for example, they manufacture batteries in South Africa, but they also have operations in Turkey and in Romania. Again, these are beneficiaries from a weaker rand. What we have avoided are companies that are purely focused on South Africa, domiciled in South Africa, like your retailers, you know, exposed to the South African economic cycle, which we think will be probably weaker and also more protracted in terms of its weakness for the next 18 months to 2 years as well.
I think, Abdul, for South African that are earning South African rands and hedging against the volatility of the rand, it's important to have that offshore exposure in their portfolios. And I know that you guys have introduced that into your Sharia portfolios. Just around some of the sort of tech stocks, and that's more sort of famously known as the FANGs, Facebook, Amazon, Netflix, Google, Alphabet, etc. What opportunities are there for the Sharia portfolios to look at those holdings?
Yeah, very good question. Out of the FANG stocks, it's really just Apple and I think Alphabet and Google that are Sharia compliant. Unfortunately, Facebook, as far as I'm aware, Facebook, Netflix, these are not compliant stocks because of the exposure to the entertainment and all of those sort of aspects as well. Having said that, I mean, our process is not just if it's Sharia, we buy it. It's also around valuation and doing research as well. And unfortunately, if you look at, or fortunately for those investors, if you look at, you know, market valuations over the last 5 to 6 years, the market has actually, and when I talk about market, I'm talking about global markets and the US market in particular, have actually been driven higher by those FANG stocks.
Yes.
You know, you need to add Microsoft in there as well. You know, those stocks have pulled the market higher. And, you know, one of the indicators that we typically look at is the breadth in the market. So when the market goes up, how many stocks are actually contributing to the market going up? And, you know, for the last 5 to 6 years, it's actually been those 6 or 7 stocks that have pulled the market higher, where the rest of the market is lagged. Now, in our portfolios, you won't find any of those FANG stocks because we think that, you know, valuations are extremely elevated. And also, whilst they have credible business models, we think that a lot of them, the earnings levels that they currently generate or likely to generate in the next 3 to 5 years do not justify their current share prices. The one exception is maybe a company like Microsoft, which is a very profitable company. But even there, you're looking at a substantially high PE multiple for that company as well. In contrast, where we find value is in sort of the beaten down stocks, those stocks that are admittedly more cyclical in nature, but they have very depressed valuations. I mean, if you look at even in the IT, I mean, we talk about the technology stocks. If you look at companies like Cisco and Intel, for example, they're still trading on, low single-digit multiples, 12 to 13 times P multiples. And like the big tech stocks, they should also benefit from increased networking, increased technology spend on all of those key drivers as well.
Yes.
So that's the contrasting sort of fortune that we see in the market as well.
Sure. So just in closing, with a few minutes left, we now want to focus obviously on investor behavior, and perhaps from your end, just to share some of the insights and I guess probably pearls of wisdom around investor behavior, for long-term investing, because I mean that's essentially what you are propagating as well as an investment manager.
Yes. Yeah, I think the key things, and again, just from my observations with interacting with people, is that there's always these get-rich-quick schemes. There's always everybody wants to start trading currencies when the rand is at 19 rand to the dollar.
Yes.
Everybody wants to invest in gold when the gold price is $1,700. Nobody invested in gold when the gold price was $1,000.
Yeah.
Nobody wanted to be a currency trader when the rand strengthened from 17 to 15, or when the rand went from 13 back to 9 rand. But the man in the street, we're not saying they're stupid. We're not saying they uneducated. But the reality is that when it sounds like everybody's doing it, it's probably not the time to get into it. And resist that temptation. And that's probably the best sort of information one can share, is to say that, if everybody else is doing it, it means it's probably too late for you to get into it as well. And you're likely to lose money. Also, this concept of currency trading, first of all, is not a Sharia compliant activity, but also, it's very difficult. I myself don't know where the rand is going to go in the next week, next year, or next month. So for anybody to make an informed decision and put money behind it is highly, highly risky as well. So I think if you don't have the time to do the homework, rather not invest and keep your money in the bank in a Sharia compliant sort of investment. If you do have the time, or if you want to, rather outsource it, to people that, their day job is spent doing this type of research and information gathering. Either invest in unit trusts, either invest in bullion or in gold directly, etc. But rather do not risk your money, your hard-earned money, in get-rich-quick schemes or trying to do it yourself with a lack of information.
Sure. I mean, that's key aspects that you've mentioned. I mean, the get-rich-quick schemes. I mean, that's a phenomenon. There's so many things that have been circulating during these times. And I've also spoken to a lot of people personally about currency trading, what opportunities there are. If you're not doing it as a professional job, it can be extremely risky for you to do. And also, as you said, the hype of, when everyone is doing it, when everyone is buying a certain investment, that's probably not the best time to be doing it. And it's also, I guess, about the conviction around that. And then outsourcing it to professionals, employ a certified financial planner, look at the asset managers and look at the track records, what are they doing, etc., and how are they investing in their portfolios and so on. And then obviously sticking to your personal financial goals that you've set yourself, and not worry about your neighbor or your friend, etc., in terms of what they're doing, where they're investing their money. So again, thank you, Abdul. Shukran for your time and sharing, some of the perspectives from the Kagiso team and how you guys are looking at the investment markets and global markets. I do hope you can join me on the Money Council again, inshallah, in the future. And we wish you all the best and shukran for your time.
Shukran. Assalamu alaikum.
Wa alaikum salam.